Hey guys, welcome to another Monday morning chat with Rozella and Steffani. Hi ladies, how are you on your bright, sunny Spokane Deer Park day? Well, how has business been over in Spokane area, ladies?
Picking up. It's finally there.
Good.
We like it.
Yeah,
However, that does not mean that we haven't had our fair share of obstacles lately.
Yes, we've had
It's picking up, but there's definitely some obstacles in the way still, but that's part of it.
All right. Well, let's talk about one of the obstacles, which was how to apply seller concessions and what some of the guidelines are around that. Is that the goal today?
That was the goal.
Yep.
To learn a little bit about that. That way we too can apply it to some of the obstacles we're facing, such as like a low appraisal coming in and how to restructure your loan and how to utilize those concessions.
Okay. Let's talk about concessions first, just some general guidelines. I know we spoke about them in another video not too long ago. So we will allow, as a lender, the seller to pay some or all of the buyer's closing costs. And there are guidelines around that depending on different loans. And generally speaking, government loans have slightly different guidelines. So FHA will allow 6%. No matter what the down payment is. And usually the down payment is 3.5% with FHA because that's why people are using FHA. They have a small down payment. 6% covers a lot of closing costs, more than you need typically. So what we will do as a lender is we'll optimize the cost structure for the buyer by using as much of the seller contribution as we can use to potentially buy down the rate. And as we talked about, there's different rate buy downs. You can do the permanent buy down, and that buys it down for the life of the loan, and you get a lower payment as the buyer for the life of the loan, compliments of your seller. Yay. You can also do the temporary buy down we talked about, which buys it down like a 3-2-1. We've talked about that. Maybe we'll put a link in this video to that video. But effectively, you're buying the rate down the first year 3% lower than the permanent rate, 2% second year, 1% the third year, and finally in the fourth year, it gets to the permanent rate. Perfect for those clients who want low payments for the first couple, 3 years of the loan for some reason, whatever it might be. That buy down for the 3-2-1 and the 2-1 buy down, you can do the same thing 2 years or a 3-year buy down, has to be paid for by the seller. And so the seller contribution is used for that. And they have to pay all of it. And it's a chunk. It's like 2 or 3% points, basically. It's what they're doing. They're paying prepaid interest. So you need a fairly substantial seller buy down to be able to do that. What I mean by that is sometimes Rozella and Steffani are very good at this. They might get a 1.5% from the seller. That's not enough for that large of a buy down, so you can't do that. But we can use those to pay regular closing costs. Okay.
Yeah.
So let's see. Conventional loans, anything less with 10% down payment, we will allow a 3% from the seller to cover the buyer's closing costs. 10% or more, you can get 6% from the seller to pay for the buyer's closing costs. And what we mean by that is anything but the down payment. Closing costs, we kind of lump that into that term and covers a lot of things. Your actual costs for the loan, that's appraisal, title, escrow, lender fees. There's points. The points are to buy the rate down. There's taxes and insurance. You're going to pay 1 year of insurance up front, so you pay all of that for a whole year, and then prorated taxes and insurance, so there's enough in the impound account to pay those when they're due. All of that we kind of lump into that closing cost name when technically they're not all really closing costs. They're reserves and prepays and stuff. However, the seller can pay all of that. That's the point of that. Okay. How's that for rambling, ladies? Any questions?
Nope.
Okay.
Okay.
Well, as I said, I know Steffani and Rozella, I work with them a fair amount, use that strategy very effectively for their buyers. And it can be very effective for a seller. And here's what I mean by this. If you're in the middle of a negotiation and you're stuck and the seller won't come down any more than maybe 3%, but the buyer wants a 5% reduction. If instead of doing a price reduction, and they know this very well, guys, if you take that 3%, say, okay, we're going to live with 3% from you, but we want to apply that to the buyer's closing costs and keep the price where it's right where it's at, just take 3% of that, apply it to the closing costs for the buyer. It's almost the same typically for the buyer's perspective as the larger reduction in price. What I mean by that, the payment will actually go down a little bit further and the buyer can save money over time. Now, every case is unique and we want to look at your specific case, of course, but generally speaking, that's a very good strategy for a buyer.
So, for example, what did you do recently?
For which one?
Your rate buy down with your concession. This one.
Okay,
Or
so
which one?
originally,
There's been so many. Good for you.
this is a fun one. So originally, seller, we need higher concessions, and we also wanted extra concessions to buy down the rate. So we asked for a large amount of concessions from the seller, asking price, but we were, countered back. No, you pay above asking to compensate the seller for those concessions. However, then appraisal comes in and appraisal is low, saying like, yeah, you raised up your purchase price, that amount, they knew what was going on. So we're then back to low appraisal. You need to renegotiate purchase price. So then goes the restructuring of loans. Okay, seller now doesn't want to pay concessions. Where do we get the money from and how to restructure the loan, because buyer does need those concessions. So what we did there, a lot of negotiations back and forth and a lot of math and numbers between everybody, lender, buyer, seller, everybody had to kind of find a middle ground there. The
And you worked it
lending
out.
side, yeah, the lending side is very important because the lender is the person who's going to be able to tweak those numbers and go, okay, the bottom line for the buyer is this. And especially the rates, how quickly they're changing and adjusting. If you're buying and getting a locked in rate, then down the road, things can adjust there. So the lending side is very important and figuring out numbers.
Yeah.
I don't know if we're allowed to get. Lender's not you, unfortunately.
Oh yeah, no, this buyer already came with a lender into totally good. That happens sometimes.
It happens. Absolutely. No problem.
From your side of it though, when you have to tweak those numbers, what have you found to be a good strategy?
Well, it kind of depends. So when the appraisal comes low, we call that an appraisal gap, which means that the appraisal is lower than the purchase price. And for our YouTube audience, if the appraisal is lower than the purchase price, we as a lender are going to go off the lower number, the purchase price, for our loan to value calculation. So if they were going to put 5% down, it's going to be 5%. Well, let me say it differently. Let's say they were going to put 5% down on the higher number. So the loan is 95% of the higher number. That loan is now greater than 95% of the lower appraised value. So what we're going to do is we're going to adjust the loan downward so it's 95% of the lower appraised value. So you have choices, right? Sometimes the buyer says, well, what the heck? I love the house. I'm going to bring in the extra money. And they can do that. Sometimes Rosella's chatting with the seller, says, no, you need to drop that purchase price so it's down to the appraised value. And that works too. And sometimes you meet in the middle, right? And we're part of that conversation a lot because occasionally what we can do is we can occasionally change the total structure of the closing costs so that the buyer doesn't have to bring in so much money for closing costs, and they'll accept a slightly higher rate to compensate for that. And it still works out because they can use their money now for the down payment instead of closing costs. Is that making sense, guys, what I'm saying?
Yeah, I
Yep.
think so.
Okay. All right. If there's a larger down payment, it's usually fairly simple from our perspective. Like some of our buyers bring in 30% down, then the loan is 70% of the purchase price. The appraisal comes in low, we don't care. We'll bump the loan up to 80% of the purchase price and still do a higher loan for them. It's actually the same loan amount for them. It's just a higher loan to value, but it makes no difference in our calculations as a lender as long as you're below 80% of the purchase price. And even then, sometimes I've had them when the buyer was going to put down, let's say 20% down, and that's all they had. And the appraisal came in lower. So we'll bump the loan up. So they're only putting 15% down and the loan makes up the difference there. And then there's a small amount for mortgage insurance, and it's not a large amount when they're putting 15% down typically. So that's solved the problem as well in different situations.
Perfect. So you have a couple of tricks up your sleeve.
Yeah, I don't know how tricky they are, but there's ways to deal with it. Yeah. So we'll be chatting with you all. Of course, you know this. This is for the YouTube audience. We'll chat with the real estate agent and say, well, here's some options. And we'll talk to the buyer and say, well, here's some options. What do you like? If we lower the closing cost, then you don't have to pay much there. The rate's going to come up a little bit, increases your payment by $48 a month. What do you think? And they go, I can live with that. And so, yeah, we just do whatever we can to help make the deal happen, of course.
Partly the reason we wanted to talk about this was because of the fact that right now, like we've mentioned before in some recently previous videos of whether or not it's a buyer or seller's market, this goes with that topic as well. That yes, in essence, it's kind of like in the middle because sellers are still able to profit a lot equity by the sale of their property. But as a buyer, you're not necessarily competing still as heavily as you were, say, even years ago. And in that, you're also able to ask for a little bit more from your sellers, which is going to be that help and that contribution. And that even goes back to our cash buyers. I've actually been successful with multiple cash buyers now of getting their closing costs covered, which is a small amount in comparison to a financed closing cost structure. But at the end of the day, a little bit always goes a long
Every
way.
penny counts.
Yeah. So
there you go.
We're with our buyers. Make sure your agent is, aggressive with their negotiations because you can right now. And be.
An agent who knows how to negotiate this stuff and knows the overall structure is worth their weight in gold. So I've told Steffani and Rozella they need to put on a few more pounds here because they're worth their weight in gold, All right. Anything else today, ladies?
I don't. So, I do actually have a question. Yes, I'm sorry. Okay. So in the event if you get a low appraisal, as we know with an FHA structured loan, that stays with a property purchase for 6 months.
And will that also for VA and USDA or just FHA?
You're correct in FHA stays there for 6 months. So I don't think so with VA, but I would have to double check that. And USDA typically follows FHA guidelines. And so that's my estimated answer for you for today. In other words, I'd have to really look at the guidelines on all of those to really give you a better answer, which I can do, of course.
Okay, perfect.
So 2 years, if you have somebody who's under contract with an FHA or a VA and you end up with a low appraisal, do not be so quick to think, or even let your agent let you think.
Throwing it back on market's going to fix it because that is stuck on that property.
Yeah.
Yes.
It's not always the case. So be very, very careful with what strategy you use for a low appraisal.
Yep. If somebody comes in with they get another FHA buyer or VA buyer, that appraisal is going to follow that property. So that doesn't fix it just by getting somebody else if they're doing the same kind of loan. You might get a conventional buyer and you might get a conventional appraisal higher, but you don't know. And in all honesty, appraisers aren't trying to kill deals. If they bring the appraisal in low, it's probably worth what the appraiser says. And the next appraiser is probably going to say the same thing.
That was the thing that I was going to add.
I was going to say that's curbing the theory on sellers' response because the sellers are trying to drive up price to compensate to allow these buyers.
Yeah.
We still have those appraisers in there going, oh, wait, hold on here. Got to keep this.
You're close,
but we got to keep it going here. So,
yeah. It's hard for appraisers to keep up with an appreciating market because the appraisers have to use sales for comparables, and they will throw in listings as well, especially in an appreciating market to show the underwriter, well, prices are really going up. You can see that by the 3 listings I have here that are higher than what the sales were 3 or 4 or 6 months ago. But the sales are lagging behind the purchase price, or the asking prices, which are higher now. And appraiser has a difficult time bringing in that price sometimes. It can be challenging.
Right. In the Spokane market, we're consistently seeing right now a lot of price reductions actually from the original list price, which again tells me that I think most appraisers are probably not going to be utilizing listings as much as they would be closing because there's plenty of closings for us to even be able to pull comps. And we're really good at that when we go to listing appointments of being very realistic with their numbers and not letting clients really drive that price.
Yep.
Clients oftentimes think
they want as much as they can get out of it. Everybody does.
Of course. Yeah.
That's cool.
But we have to
when I'm
keep
the seller,
reality.
I always think it's worth 10,000 more than you think. I mean, that's true, isn't
We'll
it?
have to be able to sell the property.
Yeah.
So.
We love free marketing. The goal is still to sell. So,
Answering our questions on that structuring.
and the appraisal
Thanks for your
question.
time again, as always. Well, all right. Well, ladies, we'll see you again in a week.
Sounds
good.
Thanks for the Monday market chat.
Thank
Bye.
you. Bye-bye.